Hey guys, welcome to the 10X Academy. This is your host JR, and in today's video I will be discussing real estate investing and how it creates cash flow. This video will illustrate examples from Graham Stephan's video titled How to Invest in Real Estate, the Ultimate Guide to Calculating Cash Flow. In this video, Graham discusses investing in a 3-unit property and how to calculate the cash flow it produces. I will be covering this in greater detail, including discussing why the number of units matters when calculating a cash flow for a property, and why investing in more units makes more sense. Please enjoy this video and don't forget to hit the like button and subscribe to the channel. This video will be focused on real estate investments for cash flow. I'll be using the same example that Graham Stephan used in his real estate cash flow calculations. In this example, the property was a 3-unit property with a purchase price of $360,000. This is an example of a real estate quadrant where you have income, NOI, expenses, and cap rate in the different sections of the quadrant. In this example, we have rental income of $1,000 per month per unit. Since we have 3 units, the total income is $3,000 per month. Now, assuming a vacancy of 10%, that's an expense of $300 per month. The effective gross income total is now $3,000 minus $300 for vacancy, which equals $2,700 per month. Now, to simplify the expenses, I assume the total expenses to be 50% of the effective gross income, which is a reasonable assumption. So the total expenses will be 50% of $2,700 per month, which will equal $1,350 per month. Net operating income equals gross income minus expenses. So in our example, we have gross income of $2,700 per month minus the expenses, which we calculated to be $1,350 per month, which equals $1,350 per month. That's our NOI. Now multiply that by 12 and you get $16,200 per year of net operating income. Now the cap rate is calculated as the NOI divided by the cost of the property. In our example, the NOI is $16,200 per year divided by the purchase price of the property, which was $360,000 plus $3,600, which is the closing cost at 1% of the purchase price. So multiply that by 100 and you get a cap rate of 4.5%. The cap rate is the actual return you would get if you were to pay for the property with full cash. Now let's take leveraging into account. Leveraging is using the bank's money with a down payment to get a bigger return. In our example, now we're assuming that we're getting a loan for the 3-unit property. The purchase price is $360,000. We're going to put a 25% down payment of $90,000, and we're going to assume that the rate factor is equal to 0.05. Now we have our real estate quadrant for assuming debt. The quadrants are comprised of debt cost, total net profit, and cash on cash return. So now for the debt cost, our loan amount will be $360,000 minus $90,000 down payment, which will equal $270,000. Our mortgage payment will be the loan amount times the rate factor. The rate factor incorporates the interest rate you will be taking on the loan. So the mortgage payment will be $270,000 times 0.05 rate factor for a yearly total of $13,500. So your monthly debt cost will be $1,125. Now to calculate the total net profit, including the debt cost for the mortgage, the total net profit will be the NOI minus the debt cost. So in our example, the NOI was $1,350. The debt cost was $1,125, giving us a total net profit of $225 per month. Multiply that by 12 and you get $2,700 per year of net profit. So our cash on cash return is equal to the total net profit divided by the cash invested. So in our example, the total net profit was $2,700 divided by $90,000 down payment plus the closing cost of $3,600. Multiply that by 100 and you get a cash on cash return of 2.9%. Notice that the cash on cash return is actually smaller than the cap rate. Analyzing this deal, you can see how adverse conditions can affect small number unit properties. If your vacancy increases, that has a bigger impact on your cap rate. In general, expenses have a significantly more impact on cash return due to the lower number of units in the property. As shown in this example, the deal falls apart when the vacancy rate is increased and the expenses are increased. In this example, I didn't include equity in the return on investment calculation. Here's another example of a multi-unit property cash flow calculation. So now let's assume we have a 30-unit property for a purchase price of $2.7 million and a 90% occupancy, which means that 3 units are not rented for the entire year. So let's revisit the real estate quadrant. Now we have an income of $1,000 per month per unit for a total income of $30,000 per month. We assume that the vacancy rate is 10%, which is an expense of $3,000 per month. So now the effective gross income is $27,000 per month. Making the same assumption of simplifying the expenses, our total expense is 50% of the effective gross income, so that turns out to be $13,500 per month. Now calculating our NOI is now $27,000 minus $13,500, which will equal $13,500 per month. Multiply that by 12 and you get a total NOI of $162,000 per year. Now let's calculate our cap rate. Our cap rate is $162,000 divided by $2.7 million purchase price plus closing costs of $27,000. Multiply that by 100 and you get an effective cap rate of 5.94%. Now let's include leveraging into the deal. So now for our 30-unit property example, we assume that we make a down payment of 25%, which will equal $675,000, and we also assume the same rate factor of 0.05. Now going back to our quadrant, we calculate the debt cost for the loan to be $2.7 million minus a down payment of $675,000. Our loan amount will effectively be $2 million. The mortgage payment will be $2 million times 0.05 rate factor. That'll come out to approximately $100,000 a year. So our monthly debt cost will be approximately $8,300 per month. The total net profit will be the NOI, which we calculated to be $13,500, minus the debt cost, which was $8,300, for a total net profit of $5,200 per month. Multiply that by 12 and you get a total net profit of $62,400 per year. Now our cash on cash return is the total net profit divided by the cash invested. The total net profit was $62,400 divided by the cash invested, which was the down payment of $675,000 plus closing costs of $36,000. Multiply that by 100 and you get a cash on cash return of 8.8%. Taking a closer look at this deal, you can see that the vacancy actually has a lower impact on the cap rate. Our 3-unit example had a cap rate of 4.5% and our 30-unit example has a cap rate of 5.94% for the same vacancy rate. We can also see that higher expenses have a lower impact on the cap rate as well for a bigger unit deal. Our total return on investment was actually much better than the smaller unit deal, which was 2.9% versus our 30-unit deal, which had a cash on cash return of 8.8%. You get a much better return investing in more units. Now this takes into consideration that your primary objective is investing in real estate properties for immediate cash flow. The resulting analysis shows that investing in properties that have more units can have a much bigger return on investment than investing in smaller unit properties. The number of doors matter. You get better cash on cash returns on bigger properties with more units. Bigger properties with more units appreciate much more due to significant cash flow and ROI. There's also better opportunities for better interest rates on bigger deals. Bigger deals also give you the option for refinancing, allowing for quicker returns on investments. Bigger properties with more units are also easier to exit. Cash flow is king. The more units a property has, the more money you make, and the better your return. Consolidating your investment deal on a bigger property with more units is better than diversifying your portfolio with smaller properties with small units. The advantages are much better and the returns are much higher. Thank you for watching this video, and I want to personally thank Graham Stephan for his excellent video, How to Invest in Real Estate, the Ultimate Guide to Calculating Cash Flow. Link is in the description. If you enjoyed this video, please hit the subscribe button and smash that like.